All right, so that was a quick setup. So we got a few errors we got to fix. The first thing is on the dollar duration gap. Rather than putting a dollar duration gap up here, let's move it over here to the side. So let's move all this over. And we'll do dollar duration. So we know how much our swap should be. And so what we need is the duration of our portfolio. The one issue we really have here is we're assuming the duration of our bonds and our liability stays constant over time, and it doesn't. Duration changes, interest rates change. I don't think we can get that sophisticated here, so we're going to be a little bit messy, no question. If you want to do that, you could. It'd just take you a lot of work to figure that out. But we're going to be a little bit messy, so it means it's probably not going to be as good as you'd actually do it in practice. So we're simplifying some things. But our portfolio is our stocks plus our bonds. And we have 75% in bonds, and the duration of our bonds is 5.24. So there's a dollar duration of our assets, right? Minus our liabilities times the duration of our liabilities. So does that look correct? And what do we do with all of that? We divide it by the duration of our swap. Duration of our swap is where? Right there. So there's a notional. Now I'm going to have to lock some of these things in. R plus S is fine. C5, got to lock that in, right? W10, don't know what that is.
That's the liabilities. It stays
Yeah.
separate.
Yeah.
Oh, that's the same. Okay, times F5 divided by E5. All right, so let's copy that down. You notice the duration is much lower now because we have so much more in bonds. So now when we do the swap, we take that times that. So that should be better. We'll see. Wow, look at that huge difference. You can see why people don't. I mean, it's pretty obvious. You put 75% in stocks instead of 25% in stocks, you can be a lot better off. So our question isn't you can be better. There's no question that if you'd done this strategy in the 80s and 90s, you would be much worse off. But we're thinking about risk and volatility. What can we express this by? So let's look at the percentage change in the surplus.
You could look at the downside.
Yeah.
Which one lost?
Yeah, what was the worst year? So percentage change, we have 579.83 divided by, what was our beginning? 3 billion minus 27. So ending minus beginning minus 1. And then we do the same thing here. Ending divided by beginning minus 1. Y'all agree that's our return, right? In scenario 2, the exact same thing. Plus that divided by our beginning. 3 billion minus 2.7 billion. Minus 1. We can copy this one over. It's going to be very volatile because it's very levered. All right, so let's try average, standard deviation, worst case, 10%, whatever you want to do. I know that's not how you spell average. So equal average. Equal STDVP. This better be higher if we did it right. Let's see how much we got it down. Equal min. Yeah, I'm worried that this isn't correct because we should be much better matched. So there's probably something I don't have set up right. I have to look at it. That's part of your job.
Look at the 10.
states. Here's a, I don't know why I can't figure out what I want to do. Right, so that worst case 34 is probably the one we're going to work on. There's probably an error in here somewhere, and that's probably where it is, so we need to go figure out what that is. Let's look at that worst case scenario. We have some in stocks. So the stock market was pretty bad, in fact, both of those years was pretty bad. So our stock market should have fallen some. Our bonds are down. Why are our bonds down? What did interest rates do in that year? Where am I changing interest rates? Interest rates rose in 74, so that's because interest rate inflation, but our liability should have fallen quite a bit. So let's see what our liability did. Our liability fell. What I don't understand is why scenario 1 is better than scenario, well, it's not. It's 34 versus 55. So decent work. There's probably some error in here that I'm not fully familiar with. Now, you could also try, if you wanted to, forget about the stocks entirely. You just don't have anything in stocks. You could certainly try that and see if so there's different, that's why it's better to put those percents. Now, obviously, that's going to be a much, much lower return. That 18% seems really high, but that's not the return of stocks. That's the return of your pension surplus. It's very, very levered. It's like having stocks with borrowing money to do it. So I still don't like this worst case scenario. So there's something going on there. So that's why you need to, sit back and look. There's definitely something coming up that I probably don't have it set up quite correctly. So there's probably a better way to get it worked out. So this should be pretty close to zero. See, there's a big year right there. Why did that happen? Your surplus grew 43%. And why is that? Your liabilities were up. Your assets were up. Oh, you gotta change this too. So make sure, don't do what I did. Don't put your percents inside the formulas, because then when you got to change everything. So that brings it down some. So much lower return, much lower risk. So it works, and that's what you're going to be up against. There's no way you can get a high return doing this strategy. Absolutely impossible. So your goal is, you have to get back to why does the pension plan exist? That's what its purpose is. So. And this return looks like a low return, but it's even lower than that because it's very, very levered. So there's probably some error in here, and you go figure out when you build it what the errors are. Find your errors, as I always said in class, find your errors at the extreme. Find those really, really bad years or really, really good years. Given that you're trying to get it really low volatility with the swap, those really big years, that's where you're going to find your error. You're going to find something you didn't set up correctly. One thing we're probably doing incorrectly, and if you want to try to make this more precise, is look at the duration convexity when interest rates are 5% versus when they're 18% versus when they're 2%. So if you wanted to, it'd be a lot of work. You could come in here and run each one of those interest rate scenarios, so like in the 70s, 15, and just get these two numbers. You'd have to do one at a time. It'd probably take you 30 minutes to do it. But then your dollar duration gap would be much more accurate, because your liabilities and and you have to do this. You have to do the same thing with your liabilities too. Whatever that other plan is, you have to do the same thing here. So that is probably not. That's not the one. Wherever it is, got too many files open. Wherever it is, that'd be more accurate. And then you'd have to have a column, the duration of your intermediate term bonds and the duration of your liability, and you have to have those every single year, so you reset your swap each year. And that's probably why we're getting so much volatility.